Hello and welcome to The Resilient Investor with me, David Stevenson.
Joining him, Sam Ridley, as always.
Sam, good to see you again. We've got a slightly different episode this week, haven't we? We've got a live fund manager with us, Joe Bauernfreund from AVI. Very interesting outfit. Going to talk a bit about styles of investing, everything from value to growth, and also about why you would do an investment trust maybe over a passive fund. Have you been buying anything kind of value orientated or passive orientated recently, Sam?
No, I've been on the sidelines for a while trying to time my purchase, which is always tricky. Nothing's taken my eye at the moment. Everything seems to be riding to the top. So seeing if there'll be a break in momentum soon to purchase at better value.
So have you been putting off buying because you think the stuff's getting expensive?
Yes. Timing has stung me this year. When I should have bought, I didn't. I probably sold. Now I should have been buying. I'm watching and waiting. So yeah.
And why do you think that? Why are you watching and waiting? Do you think that stuff has got just too expensive, particularly that kind of American stuff? What would you be looking to buy at this point in time, but you're not?
Well, a lot of the businesses that I was watching in the early part of the year, I was following one, Mercado Libre, waiting for the timing it went from COVID high, peaks and troughed. I didn't buy. I thought it would go lower. Then it began to rise, and I've watched it over the last 15, 20% as it's, gained its price back. And now I want to wait for the next dip.
Yeah, it's a classic kind of situation. Joe, so...
And now I found myself stuck, David, effectively.
Yeah, found yourself stuffed. Joe, we've got video here, so we can see you smiling away with the classic problem of trying to run money. Let's actually kick off with that very simple question. Joe, give us a bit of background about AVI, but you for instance, manage investment trusts, yeah? So you're constantly managing equity portfolios. And it's probably the most difficult job is to sort of work out when to buy, isn't it, quite often? And this classic problem that Sam's got really, which is you found a share that you really like for whatever reason. And we'll talk a bit about styles of investing shortly. What is the discipline you have to be a kind of fund manager to do that? Because you must identify stock, and do you put thresholds and targets in and say, I'm not going to buy above X or Y? How do you actually just do the physical bit of trading?
Well, thanks for the question and good to be here as ever. I'm smiling because, this is an age-old question and a lot of people struggle with it. And clearly the temptation is to time your purchases and your sales indeed perfectly, always buy at the bottom and sell at the top. And particularly after we've had a run up in markets, the natural thing is to worry, have you missed the boat? Should I wait for a setback? And over the years, what I've noticed in my own mind when I've dilly-daddled about making decisions and held back or waited for a better price to come out or go in, that the majority of the times you get one leg of that decision right and you get the second one wrong. So you can buy well and then you sell badly, or vice versa. And over time, as you suggested, we are equity managers. That's our job, to run equity portfolios. My belief very strongly is that market timing does not work. And it's clear to me that there's a danger that in trying to time the markets, you'll find yourself out of the market just at the time that you really need to be in the market. And that is those days when you get big moves up, and that tends to be the day that forces you to come back into the market, and obviously the price has already moved, and a big part of your returns you will have missed out on. So my philosophy and belief really when we're running our portfolios is we focus on valuations, we focus on fundamentals, we focus on things that we think we can add value on and we're good at. and market timing is not one of those things. So if we can find good companies, we will prefer to be fully invested the majority of the time.
Now, you mentioned there good companies, and you mentioned that words that I think a lot of people hear but don't always understand: fundamentals and valuation. They're all kind of like styles of investing, yeah? I suppose you could call it that. I mean, what do you mean by valuations and value and fundamentals? What are the things that investors should look for when they're looking at a stock? Because a lot of investors look at the growth side, don't they? They look at, I don't know, the classic one at the moment is Nvidia, yeah, and they'll go, oh, amazing growth, yeah. They're going to sell all these AI, yeah, exactly, cha-ching, all these AI chipsets to everybody, and everybody will get very rich. So what do you look for in a stock?
Well, there's a few things going on, and you're absolutely right. There are these terms, value investing and growth investing, and they mean different things to different people. At a very basic level, the idea of value investing is that you buy something cheaper than you believe it to be worth. And growth investing is the idea that you're buying into a company or a business that is experiencing rapid growth, and it's going to be worth a lot more in future years, with the idea being that when you look at the valuation of that so-called growth company, you might end up paying quite a rich valuation, a rich multiple to its earnings or a rich multiple to its sales, and you would justify that by believing that the particular company will experience very rapid growth in the future, certainly more rapid than a mature company.
So why do you prefer value-driven ideas and growth, though? I'm assuming you do.
Well, here's where it gets a little bit complicated, because every investor wants to buy something that they believe is going up in value. And when we talk about valuations and buying things on discounts, that's not to say that we don't want to buy companies that are going to experience profit growth, earnings growth in the future. We do. We very much do. We just want to pay a valuation for those companies that is arguably cheap, good value, discounted.
So if you want to discount, so let's take an example. So you've got a business which is growing. Say, I'm making numbers up as I go along here. It's doubling its turnover every year, and it's doubling its profits every year, and it's trading at, I don't know, people use metrics like price to earnings ratio, I don't know, 50 times its earnings. Yeah, just make a number up. Yeah. And then you've got a company that's growing 20% a year. Yeah. Not doubling every year, but going 20% every year. And its P is, say, 20. Yeah. Do you see what I'm getting at? I suppose, what would you prefer, the company that's growing slightly slower, that's got a lower PE multiple? And I'm being very specific here. Or prefer a company that's growing great guns but has got an insane ratio? I mean, you see what I'm getting at?
Yeah. Well, there's not enough information there for me to base a final decision on that. But one thing that I would say is that, you threw out PE multiples of 20 and 50. And the market is, on average, closer to the 20 than it is to the 50. So one of the things that I would think about is, what are the chances of me being disappointed? If you're paying 50 times earnings for a company that you say is going to double its profits every year, that's a very big ask. It may achieve it, but it may not. And if you're paying a premium multiple for those earnings, there is a greater risk there that you're going to be disappointed because it won't achieve those earnings. And then you've ended up paying a very rich multiple for a company that's not going to achieve its growth. Whereas if you've got a more modest growth expectation and you're paying a more modest multiple for that, then the chances of you being disappointed are less. It's fair to say, though, that if you are right and that company doubles its earnings, or indeed trebles and does better than expected, then your 50 times multiple may end up appearing to be quite cheap and quite attractive, and you would have bought possibly very well.
So the question is, you in a sense, you need the one with the high multiple to grow into it, and consistently keep doing that. And I suppose that's where you've got to look at, like Warren Buffett style. You've got to look at the underlying business and understand how is it. I think the expression I've heard Sam use as well is compounding. It's just compounding every year. That's I suppose the sweet spot, isn't it, of a business that is just compounding every year, just solidly, knocking its targets out. That's I suppose the ideal stock, really, in many respects, isn't it?
That's right. To confuse things further, there are different types of value investors. So there are some value investors who want to pick up what Warren Buffett called them the cigarette butts, or something, the things that are pennies in the pound. So assets that are worth £1 trading for 80, 90 pence. You sell the assets, you get back your pound. The business hasn't really grown in value, but it's got assets that are worth more than the current price. If you could monetize that's one form of value investing. Other forms of value investing are sort of more in line with our thinking and with how Warren Buffett, I think, developed over the years, is to move away towards those compounders, those companies, good quality businesses that are growing, but to pay a reasonable valuation and to minimize the possibility of one being disappointed with the outcome.
And you mentioned discounts, and one of the areas that a lot of people look at the moment for buying cheap stuff is they look at investment trusts. And I think for a lot of mainstream investors, you've got investment trusts and ETFs, haven't you, Sam?
Only ETFs at the moment. Investment trusts, not.
Now, so I suppose one of the reasons you might look at investment trusts at the moment is they're cheap. Yeah, a lot of investment trusts are cheap. They're trading at big discounts. Yeah. And AVI traditionally have invested in investment trusts as opposed to passive funds. I suppose, so is the argument for maybe looking at investment trusts, let's take apart the argument about why you should invest in ETFs versus investment trusts because of the way they're managed. But you might look at investment trusts because they're cheap at the moment. You could be buying £1 of assets and you might be paying, I don't know, anything between 80 and 60p. Is that an area that investors are like you are looking at the moment? Because did you just buy good quality assets cheap?
Yeah, absolutely. I think that the investment trust sector as a whole is trading extremely cheaply. There are lots of very well managed investment trusts that are trading on wider than average discounts that we haven't seen for many years. There's generally, when we look around the marketplace, there's more sellers than buyers, and that is what is fundamentally weighing on the discount. And it's a rich opportunity set for us across the board, across the investment trust sector to take a look at. So absolutely.
So what kind of things are you buying at the moment?
David, I should just say, I do have Scottish Mortgage Investment Trust, but that was a darling of my 2020 season. And so, the last couple of years, I've just let that sitting there. But I do have Scottish Mortgage in my free trade portfolio.
Which happens to be one of the biggest investment trusts in Britain. So would you be buying in Scottish? I doubt you would be, but Joe, would you be buying Scottish Mortgage at the moment? But what is it? What kind of stuff are you buying at the moment in investment trust land?
Well, Scottish Mortgage is interesting. As you indicated, Sam, it's had a fantastic track record over the last 10 years or so. It's had a much tougher environment over the last 2 or 3 years. And alongside that, it's gone from a premium rating, so its shares had been trading at a premium to its net asset value, to trading on a discount of almost as wide as 20% earlier this year. I think it's moderated a little bit, but it's still on a sizable discount, certainly compared to its history. So those kind of things are interesting. When you've seen a derating of a trust with a good long-term track record on double-digit discounts, very much wider than average, that is interesting. We don't own Scottish Mortgage, but it's certainly something that we've looked at. The environment is clearly more challenging today for growth investors, for investors into technology companies, the kind of things that were so successful for Scottish Mortgage. And at some point, I expect their time will come back.
Hurrah.
So what is it? What are you kind of buying at the moment that you think is cheap then in investment trust land? I mean, are you buying Japanese stuff, for instance, at the moment? I mean, Japan's always regarded as quite cheap.
So we are buying Japan. We've got roughly 20% of our AVI Global Trust invested in Japan. That is invested into direct equities in Japan. So operating companies, operating businesses listed on the Japanese stock market. And many of the companies that we've chosen to invest in Japan remarkably have huge amounts of surplus net cash sitting on their balance sheet. And in some cases, that net cash amounts to the majority of the value of their market cap, leaving these successful, profitable operating businesses trading on very, very low multiples. And so that is a very interesting area for us. It's also an area where the government and the regulators in Japan have been focusing on encouraging those companies to do more productive things with their cash, and at the same time to push for higher share prices by running those businesses more efficiently and more effectively. So it's an environment where one can still find lots of good quality businesses trading at low valuations, and where there is something actually happening to push those prices higher.
And I think that I just want to finish off by, so in Japan, you're much more active, aren't you? And that's another term that people hear is activist. That's probably become more common in the last 10 years, isn't it? People hear about activist investors. Disney on and off has always had people like Nelson Petz kicking around, trying to, get on the board, get off the board, get on the board, do something not. And activist has become a more popular term recently as well. But that not all activists are the same, are they? So you're quite active in Japan, aren't you, for instance? So what would an activist investor look like? And are you an activist, or are some people just more active rather than activist, if I can make that point distinction?
Yeah, it's confusing. I think the broad idea behind activism is that as an owner of shares in a business, the idea is that you should act as an owner of that business. And if you're not happy with something, or if you've got ideas or suggestions, you should make those known to the company. So at the extreme level, you get aggressive activists who run very aggressive public campaigns seeking to embarrass incumbent management, telling them they're doing a lousy job, and that they could do a better job, and this is what they would do. And there are other forms of engagement or activism that are more conciliatory, constructive, respectful. And sometimes those go on behind closed doors and they don't see the light of day, but investors nevertheless do make their views known to management. So that is another form of active ownership, I would say. I would probably position us somewhere in the middle. So we're very comfortable with the idea of making our ideas known, and we see that as part of our value-added proposition, that we are actively engaging with the managements of our companies, making suggestions as to what they can do to improve things and get a higher share price. We're also comfortable with the idea of sometimes those discussions going on in the public domain, sometimes constructively, sometimes a little bit more aggressively. Our starting point would be always to do things privately and respectfully. But as I say, sometimes it doesn't work, and you need to take those into the public domain.
And does it work in Japan? Because you always hear about people in Japan being a bit culturally sensitive, let's put it that way, to foreigners telling them what to do. So does it work in Japan, or was anything?
Interestingly, as you suggest, historically in Japan it hasn't worked. And as a society, they've never really done well with the public shaming aspect of activism. In the last 5 or 6 years, as you've had the corporate governance reform measures introduced by the government and by the regulators, in Japan. That has led to an environment in which companies have become much more receptive to the idea of having engaged shareholders on their registers. At the same time, those shareholders, such as ourselves, have learned from the failings of the past and have learned that to be successful as an activist in Japan, it helps to be respectful and not seek to publicly embarrass anybody, but to demonstrate that we have an alignment of interest, we want the same things that they do, and we recognize that the way things are done in Japan is perhaps different to the way things are done elsewhere. But there is clear evidence nowadays that activism, constructive activism in particular, has been very effective in Japan over the last few years.
I suppose the last question before I just quickly, I see if Sam wants to ask anything, is what's your take on where we're heading in the next kind of few months to a year? I mean, you hear a lot of talk about slowdown, recession, all that kind of stuff. I mean, none of us know. All our crystal balls are useless at this kind of stuff. What would you guess is going to happen in the next 6 to 12 months? Do you think we're going to have a roaring 2024, or do you think it's going to be a bit of a miserable 24?
Yeah, my guess would be that we continue to muddle through. And it's a market environment in which it's, broadly speaking, challenging to make major gains, but probably avoid major losses as well. It's an environment that's much more conducive, I would argue, to the kind of stock picking approach that we adopt and the active ownership approach, where you can't rely on markets doing all the hard work or the heavy lifting. And it's really about picking individual stocks where something is happening or where you can generate some kind of event or catalyst to unlock value, rather than sit passively by hoping for the best. So I'm afraid, Sam, I would argue against having too many ETFs and trying to find some good funds out there.
Certainly on my to-do list.
Sam, any questions? Have we tempted you, Sam, to look at investment lists?
Indeed, you have. Some Christmas reading, planning for next year. I do have a question, Joe. Do you think the number of, or do you know that the number of companies has either increased or decreased that have been targeted by activist investors over the last few years? Has it become more of a... Is there a greater volume of companies targeted by active investors recently?
I would say so. I would very much say so. And I would also go back to my earlier response in that there are different types of activists, but I think as part of the ESG revolution that we're all familiar with over the last few years, the G part is all about governance. And what we've seen as a trend, even the most passive institutional shareholders are being forced to focus on the G alongside all the environmental efforts that they make. The governance side forces them to act more like owners. And if you're an owner of a business and you're not happy with something, then you have to say so. In the past, I think too often institutional shareholders didn't want to upset management. They didn't want to ruffle the feathers. They ticked the box. They supported them every AGM, supported the resolution, supported the directors, and that was that. Now there's more scrutiny on how they vote, how they communicate with management. So even at that level, we're seeing a lot more engagement from shareholders. And then at the other end of the spectrum, there are investors out there who have built their businesses on the idea about being quite aggressive, publicly shaking up management and getting share prices to move higher. And we've seen an increase in that too. So across the board, I would say.
So as an aspiring stock picker, it's worth keeping my eye out for businesses that are being targeted by activist investors as a positive force for change within that business that hopefully will lead to good financial outcomes. That's something I'll be keeping my eye out for.
Yeah, that makes sense.
Joe, I was going to ask you that, Joe. Is it, because obviously we've meant, there's some high profile activists out there. I mean, it's difficult to know about this unless you do it as an academic study. Is it a smart idea sometimes to jump on their coattails and expect the stock to keep going up, or is it? I imagine it's trickier than that, though, isn't it?
Look, I think what clearly has been a trend over the last few years is that activists have been keen to demonstrate that they're not just bullies. They're not just beating up companies because they don't like them, they don't like management, or they think they can do a better job. So when you read the material that activists put out when they've targeted a company, it's generally high-level stuff. It's good arguments, good solid arguments as to why they think the current structure of the business, for example, isn't working, why it's led to an undervalued share price, and how following a particular course of action will unlock value. So if that is the case, then sometimes riding on the coattails of activists, is a good idea. And if stock markets, a lot of people argue that the UK stock market is cheap and it's unloved and it's been ignored by lots of investors for a variety of different reasons. What we've seen over time, if that is the case, then there are investors out there who will come and exploit that, and they'll take over companies at what they believe to be attractive valuations. That could lead to short-term jumps in share prices, which could be very, very helpful to investors. But if the public market, the idea really is that if the public market isn't good at valuing companies, then there are investors out there who will seek to exploit that.
Right. Okay. Well, so Sam, I think the moral of the story is investment trusts, Japan, and look out for activists.
Indeed, in that order.
Joe, in that order. Joe Bauernfreund from ABI, thank you very much. And until the next episode, thanks for listening.
Thank you for having me.